now.
Hello, I'm going to cover corporation tax on coronavirus business grants today. And my objectives are really to raise awareness of the taxation of these grants, since the information is not generally getting through. Not to go into complex technical detail, tax is complicated, but to cover the basics. So the topics I'm going to cover are shown on the top of the tabs on this slide here. The type of grants I'm going to be talking about, a reminder on the framework for corporation tax, which is quite important, corporation tax on the grants, whether there are any exemptions, and if so, how to take advantage of them, and finally, what action you need to take. So firstly, dealing with the grants I'm going to cover, the most important and substantial for many clubs are the local authority business support grants, which started last spring. These can have contributed to clubs of up to £60,000 so far. And you got the grant basically if you were on the business rate system and you had a rateable value for your ground. And that was the basis on which the grants were made, and the amount would vary on your rateable value. So that's the first very important type of grant I'm going to cover. I'm also going to say a few words about employment-related grants, the so-called furlough scheme, which is still continuing at this point in time. And it's important to bear in mind that when looking at these grants and the tax position, you probably will have to look at 2 financial years, 2 accounting years, depending on when you accounted for the grant. So it's not just a case of looking at a single year. And in fact, the whole process, I think, will do clubs a real favor in looking at the corporation tax position. I'm not going to cover the multitude of other types of grants that rugby clubs may have received, including those from Sport England or the Winter Survival Fund money, which came from Sport England to the RFU via the RFU. These may very well have tax implications, but I'm not going to cover them today. So let's go on to the framework for corporation tax filing. Hopefully those that listened to the webinar I presented last October will be familiar with this, but in case you're not, and I would recommend that you revisit that webinar, which is on YouTube and also on the RFU website. What we have to identify for corporation tax purposes, even though you might be principally a members club providing services to members, rugby to members, we have to identify whether there are any profits from taxable sources. And the usual taxable sources that you will find in a rugby club fall into those 3 categories. Usually non-member income we're looking at here. Firstly, bar trading, i.e. where non-members purchase beer, drinks, food at the bar, and that can include guests and visiting teams. Sponsorship income, which supports rugby clubs significantly, very important, but that is a taxable source. And finally, when the club is rented out, either, for example, for a play group during the week, or for functions, for birthday parties, anniversaries, etc., etc., etc. What we have to do, having identified from the accounts whether you've got income falling into those categories, you've got your source profits, but you have to source income, but then you have to identify the profits from each of those sources. So you are allowed to deduct costs, and my webinar explains some of the costs which you could deduct. So having done that process, you've got your trading income, perhaps some rental income from renting, you've deducted the costs from each of those sources. You've then got your source profits, but that's not an end to the matter, because before calculating the taxable profits, you allowed deductions for donations to charity and any expenditure on grassroots rugby. Very important. The latter was introduced in 2017 and allows a club to deduct up to £2,500 a year for spending on grassroots rugby from those taxable profits. So having done that process and gone through it all, gone through that framework, you then pay tax at 19% on the taxable profits. The rate is due to go up to 25% in 2023, but it's not likely to impact sports clubs because there will be a lower rate for small, what they call small companies. So that's the framework into which these LA grants fit. Now let's just look at how those local authority grants are taxed. I mean, I think the first point to make is that we're not relying on the existing tax law. In Finance Act 2020 introduced specific provisions for taxing both local authority grants and furlough grants, and indeed some others, but we're going to concentrate on those two. And the legislation was not altogether clear, and indeed the revenue's detailed guidance hasn't made it much clearer. But I've had a number of conversations with the revenue on how this will impact sports clubs, because obviously this legislation applies to all companies in receipt of these grants, not just sport. But sport, as we will see from the framework I've just gone through, is not straightforward in arriving at corporation tax liabilities. So fully taxable, these grants are fully taxable, so it will impact all those clubs on the business rates register that receive grants. So that's a very important point. Now, the way in which they will be taxed will depend upon whether the club has got trading income, property income, or no business income at all. I'm not going to go into the detail of how the grants are allocated to those various categories, but that's something which each club must look at to see whether it has got trading income, has got property income. And if it has not, despite the fact that it only provides services to its members, it is still taxable. Now, this must seem to be counterintuitive, but the revenue and the Treasury have failed to recognize the fact that most clubs, a lot of small clubs, will not have taxable income in the first place. But nevertheless, these grants will be taxable and CT returns may be required. So if you do have trading and property income, you may need to apportion the grant. You will need to apportion the grant between the two sources. And then the part of the grant that you've apportioned, the local authority grant that you apportion to each source, will be added to the income in computing corporation tax, the corporation taxable income from each source, which I talked about previously. Expenses will be deductible. And then when you've arrived at your allocation, your calculation of your taxable income for each source, you will, in the same way as I described before, have some total profits from each source, deduct any grassroots expenditure, and come up with taxable income. So that's really the process which is grafted on to what was already there. I suspect, however, that many clubs have not gone through the process for determining whether they have trading or property income, because they've not been aware of the position. And this is where those clubs that are not filing CT returns will really need to start to put their thinking caps on. So just moving on to furlough grants, these are relatively straightforward to deal with. I'm not going to spend much time speaking about them. They are taxable, but only if there is trading or property business currently being carried on, or being carried on in the year in which the grants are being recounted for. And in any event, if they are taxable, you will be able to offset the employment costs, because the condition of the grant is that you furlough your employee, but you still pay him or her. So there should be no practical impact for corporation tax purposes, because if the grant is taxable, the employment costs are offsettable, no net result. So exemptions. Does this impact everybody? Well, I think every single club in receipt of a grant must look at its position, whether it's a cask, a charity, or whatever its status. I have put the first bullet on there, mutual trading. Grants that are allocated to mutual trading, or if the club is only mutually trading, are exempt from tax. Now, as I say in the brackets there, this is unlikely to be the case. Firstly, because the revenue accept and would dictate that if you're just providing services to members, that's not a trade in the first place. And secondly, even if it were a trade, the trade is not mutual, because many clubs on a winding up, the surplus assets don't go to the members, they go to some other local sporting cause. So I will put that one aside, but it is there, and you should at least look at it when you're considering the grant position. Cask is a much more fruitful area. I've talked to a number of clubs that are casks, and they are by and large quite comfortable with the position on the grants. Firstly, the good news is you do not have to include the grant when you are calculating whether you breach the 100,000 per annum non-member income condition that's written into the legislation. Secondly, however, you do have to include the grant in your trading and property income for considering whether the corporation tax exemption limits are breached. So I've just gone through the process, and if you come up for the figure of property income or rental income that is above 50,000 or 30,000, that's the gross income before expenses, then tax will be payable. And the good news is also that for the purposes of those exemptions and for the purposes of the 100,000 income condition, you ignore fellow employment related grants. So if you're a CAS, you need to look at it, but you may not be in the nasty position that you have to pay tax on the grant. Charities, I'm not going to go into detail, but the tax exemptions for charities are much more extensive than for CAS. And I think it unlikely that a charitable sports club, a charitable rugby club, will pay corporation tax on the LA grants, but it still needs to consider its corporation tax position as it would do in any normal year. So quite a whistle-stop tour so far. That deals with the framework, the grants themselves, other tax and exemptions. What action do you need? Well, self-evident from what I've been saying, please review the impact of the grants on your club for corporation tax purposes. You cannot just close your eyes on this one. The legislation says they're taxable, and if you don't follow the legislation, you will be potentially subject to payment of tax, interest, penalties, and all the rest of it. CAS and charities may still be exempt. I think that's quite likely for most CAS and charities, but you still need to look at the position. But this is the real kick in the teeth, that non-registered clubs, I think, are likely to pay some corporation tax because the income will be subject to tax, depending upon what the year is like, obviously, because we're talking about the pandemic where presumably not a lot is going on in terms of income and expenditure, but you need to work through the figures. And this is a reminder worth pointing out. This is a self-assessment system. You cannot wait for the revenue to remind you. If you have a corporation tax liability, you have taxable profits, you need to file corporation tax returns, you need to self-assess. And that may mean that you need to take professional advice because the position is not at all straightforward. And also, since these returns are filed online, you will have to have a facility for filing the returns online, and that may need some professional help. So that's a quick run through. My details are on the bottom there, and I hope I've at least prompted you to think carefully about corporation tax, specifically in the context of local authority grants. And do have a look at this webinar and the corporation tax webinar again. I'm sure it will help you through the process. Thank you.